Welcome to Kelly Minds Her Manners, a podcast about real estate and entrepreneurship with a twist. Here's your host, Kelly Robinson.
Hey. Today I am chatting with self-proclaimed nerd, the incredible Logan Mohtashami. Logan Mohtashami is a housing data analyst, a financial writer, and blogger covering the U.S. economy, specifically the housing market. He is also a lead analyst for HousingWire. He has been invited to speak at many conferences and is a frequent guest on CNBC. Logan has been called a social media star by National Mortgage News and the Chart Guy. He is an astute analysis of economic data and has years of direct lending experience, which allows him to present a unique, informed, and unbiased perspective on the financial markets. Please welcome Logan. Oh, not only do Logan and I talk nerdy, we also get to know him a bit more personally at the end with my not so fast five. Does Logan answer all 5 questions or does he take his 2 passes? You'll have to find out. So thank you so much for coming onto the show. I have been so excited for this day for quite some time since you agreed to do my podcast. I'm just really excited for our audience to hear all of the things that you have to say. And I really want to get to know you as much as possible. I guess my first question is what led you to this niche part of the market that you're in? What excited you about real estate? Have you always been interested in real estate since you were a kid?
So our family has been in banking since the late 1950s. So I'm the 3rd generation into this. And our family in America, we opened our own mortgage company in 1987. So about 1996, when I was old enough, I started to help out in the family business and then became a loan officer myself. My whole game plan was actually to coach high school basketball and teach history. That's what I was going to do. But when I got into finance in the late 1990s, I really enjoyed it. And so I gave up the teaching gig. And I've also, I'm a historian and I love numbers. So in 2010, I created my own financial blog just to talk about housing economics, and did not have any intention to take this to the level I am now. But one thing led to another, and I can't just do anything normal. I want to be like the best at what I do. So over the years, I've developed it from just being a financial blogger to, in a sense, how a data analyst would look at the economy. So I have to look at economic cycles first, then look at the housing market. So there's a specialty in housing economics, but really just do what data analysts traditionally do. And I've been doing it for over 10 years. Toward the end of 2019, HousingWire asked if I wanted to write for them. And I was, thinking about, retiring from the mortgage industry. And when 2020 came, COVID came. And for me particularly, a lot of my housing economic work is demographically based. So I used to always say in the last decade, we would have the weakest housing recovery in terms of sales, housing starts, construction, those things. But in years 2020 to 2024 is going to be different. Demographics will be better there. I always have this running skit I used to do at every event and say, we're really simple people to understand. We rent, we date, we mate, we get married 3.5 years after marriage, we have kids. Housing was always going to be a year's 2020 to 2024 demographic patch because the biggest housing demographic patch ever was going to come into their first time home buying age there. So when you add move-up buyers, move-down buyers, cash buyers, investors, first time everybody put together, housing demand will be a little bit better than what we saw in the previous decade. Then COVID came. So I'm like, okay, that threw a wrench into everything. But you have to create recovery models. So I think what people know me for is on April 7th, 2020, I wrote a recovery model for America and the housing market for everything to return back to normal in 2020. So then everybody's looking at me crazy, of course. HousingWire thought about maybe we should not publish this. This is pretty crazy. And of course, I mean, think about it. We were hoarding toilet paper at that stage. The last thing anybody is thinking about is, oh, housing's going to recover, and maybe we really need to worry about home prices taking off or stuff like that. So nothing. At first, people just thought I was crazy, but then we put dates into that model and everything, and then we got the country to realize just follow the economic data. And we had the biggest and fastest recovery in U.S. economic history, which didn't surprise me. But unfortunately, what occurred is total inventory in America broke to all-time lows at the worst period ever for us. And we had this massive housing inflation on a historical basis. So I'm just like a giant nerd that just looks at data all the time. So
I love that.
Yeah. So I'm able to actually just, I can write about it now and do videos. So it's been a lot of fun for me. Because the old high school basketball coach in me is still here. So I just love talking to people and talking about fundamentals, just like a coach would talk about, to the kids he's coaching about basketball. So that's kind of how I do it. So I always say economics done right should be very boring, right? But like economics is not designed to be this fun, sexy discussion or anything.
No, but you make it fun.
I try to make it as fun as possible because I know that, in this day and age, the attention span isn't that long. And if you just talk about trend numbers, they're not very exciting. So I'm here to somewhat just make it as fun as possible. And hopefully people can learn some things for their own. Because if I do my job right, a lot of people can almost finish my sentences for me because we've developed that relationship. We trust each other. So what I say is, I'm not fabricating. These are just economic data lines and we follow them. If this changes, that should change. And people have a better sense on their own.
Yeah. I mean, that's cool. I love that you were into sports and history and all of that stuff, because unlike a lot of people in your position or, who talk about the economy or economists and what analysts, you actually are interesting and fun to listen to. But you do have that side of you. Like I'm super nerdy too. And I love charts and data. And I always look at your charts and you help me sound more intelligent to my clients. And it's really, New York City is such a niche, but it's really important to also understand the rest of the country. And you really break that down well. So thank you.
I try, yeah.
Yeah, you do.
I try, and I'm glad, and I think I'm very happy to be at HousingWire because the audience is much bigger now, and touring around the country. We're in New York last year, and we had a cocktails with Logan event, and a lot of people are there, and just talking with people. Just thank you for showing me this, and it helps me. That's really what I do it for. Right.
Yeah.
I retired in 2020. I actually was going to stop writing altogether at the end of 2020. I had no intentions of doing it any more than just one economic cycle. But then I realized that there's so much bad information out there. Right. And the whole thing it's oddly enough, the whole thing on forbearance, like toward the end of 2020, housing was already recovered. So people were saying, oh, the housing prices are going to crash in 2021 because of forbearance. And I was like, that's not how forbearance works. So in September, I created the term because I'm trying to make it as fun as possible. Forbearance crash bros. That's what I call them. It's a bunch of guys on YouTube, Facebook, Clubhouse, whatever social media. And they're talking about forbearance, but you can see that they have no training or education in credit risk channels. So they're just making stuff up. So because of forbearance, I said, okay, I'm going to do this one more year. And then I decided, you know what? People are just going to be crazy and talk about crazy stuff all the time. So there has to be people in this country that you could actually trust who just focus on numbers and don't do it for the financial benefit of drawing attention to YouTube sites. And it's worked, right? It's worked. If you believe in models and stuff like that, then you could see how you can explain the housing market today clearly. But then there's all that crazy stuff outside. And again, I almost like feed off of that energy. So it's just been so much fun for me to do this at my age now that I'm so grateful that it's almost not fair how much fun I have talking about economics.
That's everybody's dream, is to enjoy what they do for a living. Not everybody can say that. And you
No.
always genuinely seem happy. And I love that. And that energy definitely, transcends everything that you do. And, it makes people want to listen to you. It makes people want to watch you. It makes people want to read what you have to offer. So it's awesome. So you said yesterday, I think it was yesterday, that the housing bubbles are led by speculators. Can you expand on that a little bit?
Well, here's one thing that was incorrect with a lot of people talked about in this cycle. Because investors grew as a percentage of sales, everybody said the housing market is in a bubble. Really, or what I call them, the housing bubble boys, have been here since 2012. They're mostly like middle-aged guys that don't like the Federal Reserve, so everything is a bubble. So they just keep on talking about bubble, bubble, bubble. So here we had this massive housing inflation. What occurs with housing or any kind of bubble, when demand collapses, supply escalates, right? And we have recent history on this. The housing bubble of 2002 to 2005 was this massive credit boom. And total inventory back there, which is where a lot of people don't know, this is why I like to do historical charts. Total active listings back in 2000 was 2 million. As the housing demand bubble was going, total active listings actually grew from 2 million to 2.5 million in 2005. The demand curve kept monthly supply nationally under 5 months. That demand curve cannot be sustained. That's what a bubble is, a complete, dislocation to reality. So when the housing bubble collapsed, inventory skyrocketed from 2.5 million to 4 million in 2007. My job is to show like the credit risk channels, and like the whole US economy changed after 2010 because of two laws. There was the 2005 bankruptcy reform laws and the 2010 qualified mortgage laws. So everybody keeps on saying we're on the verge of some massive supply that's going to come. And I'm like, that's just not how housing economics works anymore, right? Since 2012, total active inventory has been falling for many years. And then we just broke to all-time lows. The lowest point we got was last year, the 850,000 active listings. That's the lowest level ever. Today, the existing home sales report came in. Sales are back down to 4 million, back to where we saw in 2007, except back then inventory is over 4 million. Today, we're 980,000. We're near all-time lows.
Which is crazy.
Yeah.
And you also mentioned the standoff that's happening between buyers and sellers. Like, I feel that so much in my market that there's a standoff. I mean, more so in the last quarter than I'm feeling it now. People are starting to kind of come out and make offers again, and sellers are getting a little more realistic in New York City. But tell me about the standoff.
So think about it in this. What is housing in America? It's a 30-year fixed product, right? You buy a home, you have a fixed debt payment, your wages rise every year. What's occurred in America after 2008 is that from 1985 to 2007, people have been living in their homes 5 to 7 years. From 2008 to 2023, it's been 11 to 13 years. Some parts of the country are 15 to 18 years. Myself, I've been living in my home 19 years. So people have been living in their homes. As their wages have grown, their total housing cost has become really low. Then in 2012, 2016, 2020, and 2021, we've had refinancing waves. So we're sitting here with homeowners on paper never looked better. Then what happened last year is that, after March, the Federal Reserve said we need a housing reset. Inflationary data, some of them got even more wild after the Russian invasion. So mortgage rates spiked from 3% to 7.375%. And then a lot of people just said, "Oh, I'm not listing my home. I'm done." Right? So you have to realize that the traditional seller is like 75 to 82% of the time a buyer. So if new listings data isn't positive, you're losing that demand, right? We always think of inventory as just supply, but that inventory is actually a demand because that person doesn't sell their home to be homeless. Yeah. Right? The only period in time where we saw massive inventory spikes were 2005 to 2008. That period, we saw a big increase. that was what I call forced credit sellers that couldn't buy. So in a sense, they were selling to be homeless, right? They couldn't buy another home. They either rent or live with a family member. Here, we don't have that case. We have the best homeowner profiles. A lot of my charts are like these FICO score charts and credit debt charts and mortgage payments as a percentage of disposable income. They're all great. So then rates, the second half of 2022, just kept on going higher and higher. And what occurred in the second half of last year was that the new listings data started to decline year over year. And we're not working from a very high level to start off with.
Oh.
So what occurred was that people just said, "Oh, I'm not listing, I'm not selling, I'm not with rates this high." And even this last week, see what we do at HousingWire, I have something called the Housing Market Tracker. It's designed to look at forward-looking housing data, which has always worked since the 1990s. Purchase application data, where the bond market is going, and inventory data, weekly inventory that is happening currently, not the NAR data that's lagging because it's a monthly sales report. New listings data is down year over year, every week this year. So we just broke to all-time lows just this last week for this period of time. That's a demand problem as well as part of and a supply issue. So we're trying to find some kind of equilibrium. The one positive thing that happened in today's existing home sales report that I love is that the days on market is over 30 days. That means it takes over 30 days to sell. We used to be always over 30 days. It's only post 2020. My premise is that whenever days on market is a teenager, nothing good happens in housing. There's nothing good about that. That means you either have a massive credit sales boom that's not going to be sustained, or you really don't have too much supply. So how I explain it is that there's too many people chasing too few homes. So just these last 3 or 4 weeks, we're hearing, hey, multiple bids again. People are fighting for homes. How is that possible with home sales near 4 million, back to the levels in 2007? The only explanation that could happen, I always say, if anybody can read and visually see, you can see the total active listings are near all-time lows.
Yeah.
So when you have a slight increase in demand, a lot of parts of the country are still dealing with inventory near all-time lows. So there are some areas that are back to 2019 levels. Though they have somewhat of a buffer, there's more choices there, but other places don't. So when demand increases, even just a little bit, you get back into that original problem. Nobody will ever believe me until they see sales collapse. And now this last 5-6 weeks, people are, what are bidding wars happening? Well, you have to look at active listings and realize that there's so much professional grifting going on housing, especially on YouTube or Twitter or stuff like that. Those are not housing people. You have to listen to people that actually forecast and have models and stuff like that.
Yeah.
They do it more for fun, for grifting in that sense. But we are still stuck in this problem. The one positive, though, is that days on market are growing. That means you have somewhat of a more functioning housing market in terms of choices. But again, parts of the U.S. are just not that much out there.
Yeah, I mean, we have very little. I have so many buyers right now, especially in the luxury sector, which we consider to be over 4 million in Manhattan. And I have so many luxury buyers right now, they cannot find what they want. And we're searching off market properties constantly. The other thing that we do here is we look at contract signed data to kind of tell what's going on in the current market, because it takes so long from the contract signing to the closing. In New York City, it can take 60 to 90 days or more. That 3 months ago wasn't necessarily relevant to today. So we look at the contract signed data more. What market has been the most interesting to watch in this country since COVID?
In general, the areas that had the biggest home price growth gains, somewhere like Boise, somewhere like Phoenix, parts of Utah, stuff like that, or Austin is a good example. Like Austin went up like 100% in 2 years. That's not normal.
Yeah.
But what's occurred is that those areas, even they are seeing inventory declines, which is seasonal. And I think the post-COVID-19 housing market has one really crazy thing that's happened. Inventory in America is bottoming out a little bit later than it usually does. So a good example, the weekly inventory charts we show, inventory used to bottom out in January and then start its spring rise. So it's very seasonal, right? Inventory rises in the spring and summer, it falls in the fall and winter. But what's occurred is at the end of 2020, we had this makeup demand from the COVID-19 delays. So we've had late seasonal demand really push a housing demand into the low period of time of inventory. Then at the end of 2021, we had a very abnormal rise in purchase application volume. Never really happens in October, November, December. Usually that index, starts to rise the second week of January to the first week of May. After May, volumes fall. But 2021, we had a volume surge. It's running into a low point of inventory again. So that's bad. That means there's too much competition for too few homes. And then last year, starting November 9th, purchase application data started to get better because it had just a historical waterfall dive. And it's running into another low inventory period. So inventory is bottoming out a little bit later than what we were historically used to. And that's creating these bidding wars early on. So hopefully what happens this year, like it traditionally happens outside of 2020, we get an increase of seasonal inventory and it gives people more choices. Now, mortgage rates have gone up almost 1% just in the last few weeks. But hopefully with more choices, that means all those people that are listing to sell are also traditional buyers as well, and they feel a little bit more comfortable. What I don't want to see happen is that inventory starts to just not grow as much as it usually does. That means those traditional sellers that are buyers just go, no, I'm just going to wait until rates get under 6%. That's the troubling part of the housing market that I'm keeping an eye on. And even in places like in Phoenix, we're seeing this decline in inventory, the seasonal aspect, but also just a lack of sellers. Last year, the investor demand has collapsed year over year. Mortgage rates have been priced a little bit higher, but also the iBuyers in some of these, the iBuyers have mostly liquefied their positions, right? So you don't have them anymore. So you have a little bit more traditional home owners this year. So I'm just hoping that we just get inventory, seasonal increase, and then the market just works off each other. But again, it's that standoff.
Yeah.
It's two cowboys looking at each other, but with two keys, not guns.
Yeah.
And, who's blinking first, right? So when rates fell, demand picked up because even though mortgage rates were a little bit under 6%, seller concessions, the home builders are paying down for rates. People are doing what needs to be done to move product.
Yeah.
And that's what occurred when rates fell. I think some people were surprised that rates falling just from 7.37% to 5.9% shifted the dynamics. But I always tell people we are at such low levels of sales historically. Like it's really rare in America after 1996 to trend below 4 million on monthly sales. We hit that number today. During COVID, we bottomed out there. So we just keep an eye on the forward-looking data where rates are doing, but we need more sellers that sell to buy other homes for the market to get somewhat back to normal.
Yeah, I agree. I'm praying for those sellers too. My buyers want homes to move into. What happened during COVID that maybe a lot of people don't talk about, but they should, or think about, but they should?
For me, I think the biggest mistake I see people make is that they believed COVID was the reason that home buying grew. Home sales data, existing home sales, new home sales, housing starts, permits, everything broke out before COVID even hit us. That's just because the household demographics are different in years 2020 to 2024. What occurred during COVID is that I naturally thought more people would move if they're, if you're running into that, child birth stage, you should get more people that were living in smaller homes moving. What COVID did is the work from home put everything on steroids. And unfortunately, all these people that have a lot of equity, like in California, like everywhere except maybe New York, everywhere's cheap to Californian people. So if they're moving, they have all this nested equity and they're taking it into areas that don't have a lot of inventory to start with, and they're just outbidding everyone. That's an unfortunate aspect of what happened. The work from home to me is like the biggest thing in housing ever. I mean, we all had to somewhat live near where we work. if you can work, in your job, even if you're getting paid somewhat less, and you can move to a cheaper area, a lot of these places that are expensive, they're like, oh my God, I could just move 50 miles east or west, and I could buy a bigger house and it'll be cheaper. So that is a really big deal in a low inventory environment, because you're putting what we call the velocity of money, homeowners with big down payments or even cash going into areas that don't have the kind of income or assets to compete with them. And it just created this forced bidding, which was, I call it, the housing market was unhealthy in 2021, but in 2022, the first 3 months, bidding wars were accelerating. So I call it the savagely unhealthy housing market. I mean, we were seeing 40, 50, 60 people to each home because we're running into a low inventory environment. And back then rates were under 4%. That's not a functioning housing market. People should not be bidding against each other for housing, but it's just a function of having all-time lows in inventory at this period of time in history.
Do you see more commercial spaces being turned into residential?
Not as much as people think, because I think there's logistic issues with that.
Yeah.
I think there's only so much you can do with commercial buildings to make them livable. I think a lot of people just assume that every commercial building that's vacant is going to turn into a condo, a high-rise condo tower. There's logistic issues with that. So if people haven't seen any conversions occurring, there's more than meets the eye in actually fitting those properties into livable shelters. So I don't see the velocity in that yet. But the commercial buildings that can facilitate, definitely those could turn into housing units. But in general, it's not as much as people think. And I think that's why you haven't seen so much conversions happen in the last 18 months.
Yeah. Well, it takes a long time to get the zoning changed and everything else too. But we're kind of hoping that some of these, commercial spaces get turned into condos here. But like you said, it's not that easy, and it takes years. So where do you see the country going in 23 and 24, and where do you see New York fitting into that? Because New York City specifically, because Manhattan and Brooklyn tend to be much different than the rest of the country. Like in 2020, when everybody else was going crazy, we were hitting rock bottom.
High cost rents collapsed in New York for just a very brief amount of time, and then people got some good deals there, and rents then shot right back up. So they were the new leases were probably shocking to them. When I think of economic cycles, I have something where I call the 6 recession red flag model. It's a very boring historical look at economic cycles. During the previous expansion, which was the longest economic and job expansion in history, I never had the 6 recession red flags up because they were never there. What happened with COVID? COVID was a exogenistic shock. It gave us a very brief recession and a very fast recovery. My 6 recession red flags were all up on August 5th of last year. So right now, when we think of New York, we still have to think of every area is still tied to the economics of the general country. The labor market is still very solid, just because one of the things that I talked about during the COVID-19 recovery is that job openings are going to get to 10 million. Nobody believed me on this one, but I kept on tweeting it, writing about it. There are certain parts of the country where the baby boomers are just leaving the workforce. And if demand is rising, then you have to replace them. So if there was no COVID-19, we should have 159 million jobs right now, but we have 155 million. So we have 166 million people in the civilian workforce. So we're just working our way back. So that's why the labor market is still tight. The housing market went into recession on June 16th, 2022. When I talk about a recession, I mean production, housing permits and starts are falling, sales are down, incomes are down, less transaction volume. So you think of housing, home sales, it's the change of commission, right? So that is down. And then there's parts of the housing economy that are people are losing jobs. The construction area, oddly enough, had this weird anomaly. Housing permits and starts are falling, but housing completions are still rising. Just because of COVID-19 delays, we have this giant backlog of homes that still need to be built. So a good number to realize, we have 71,000 new homes available for sale. It's just 71,000 new homes available. For a country of over 330 million, I mean, traditionally it's between 80 to 120,000, but we have more homes under construction than we do that haven't been started yet than we do new homes available for sale. So the builders are trying to work through their backlog, because in reality, if their buyers knew that mortgage rates were going to jump from 3 to 7%, a lot of them wouldn't even qualify for the loan, and then most of them wouldn't even take it on. They would say, oh, the rates are too much. So the builders are just working through that. So that after that aspect is finished, then construction labor could get laid off. I'm just generally following at this stage the labor market data, jobless claims every Thursday, 5:30 a.m. Pacific times. As long as jobless claims stay low, the economy can keep on moving. But if claims data starts to rise, I have this number, 323,000, a 4-week moving average jobless claims. If that occurs, then the U.S. economy is going into a recession. At that point, though, the bond market will fall and mortgage rates should get better. And people have to remember, housing is disproportionately impacted positive in that sense, but it's also disproportionately impacted negative when the economy is running really hot and inflation and jobs are. I mean, last year we had over 4 million jobs created, but we had the biggest collapse in home sales in recent history. So when the growth rate of inflation should cool down and bond yields come down, that will benefit housing. Why? Because most people are always working. It's like people tell me, well, Microsoft laid off 11,000 people. I was like, okay, there's 155 million people working. So this army is so much bigger than the Microsoft laying off 11,000. So that's why disproportionately housing gets impacted in a favorable way, just because most home sellers, most home buyers are always working and their buying power gets better. And just this recent 1.5% move lower in mortgage rates changed some of the dynamics in housing. Imagine if rates got down toward 5% and stayed there, right? We don't have a functioning housing market because rates are moving so wild and crazy. People can't make choices.
Yeah.
So what I'm looking for going out just for this year, and maybe even in 2024, is that keep an eye on jobless claims data. If that starts to break, the bond market doesn't care what the Fed says. Fed could talk tough all they want. Mortgage rates will fall, everything. And then if people start losing their jobs, the Federal Reserve will eventually turn into that, as long as the growth rate of inflation is falling. I know a lot of people think about the 1970s, but I think people forget in the 1970s, if you're a 1970s inflation person, you are a housing inflation person. Like housing was booming back then. And home sales went from 2 million to 4 million. For us to even repeat anything like that, like we have to take 6 million home sales and get it up to 12 million. We don't have that kind of dynamics like we did back then. And rent inflation really took off. Like you can't have breakaway inflation in America unless rents take off, because rent's the majority of all inflation components. So I'm just keeping an eye on claims at this point because everything else is checked off on my recession watch. But when that occurs, housing disproportionately gets impacted in a positive way.
Good info. Thank you. Okay, so now we are going on to my not so fast 5. A lot of people do rapid fires. Okay, so I have 5 questions for you. You get 2 passes.
Okay.
You can answer all of them or you can answer 3 of them.
Okay, sounds good.
Okay. What is something other people value that you don't necessarily value or subscribe to in life in general?
Just that their beliefs in politics is more important to them than their value as a human being.
It's a good answer. Are you more, I think I know the answer to this question, but I want to know, are you more of an introvert or an extrovert?
I am a huge introvert, which shocks people because when they see me live at events and everything, I take tons of selfies with everyone. I'm not saying that's for show. I mean, I'm good with people when I need to be, but I'm just like, I just want to sit home and look at data. I'm like the biggest nerd in the world. I'm literally like Saturday nights, I'm up to 1 o'clock in the morning writing stuff. And I was just like, yeah, I'm not that guy ever. So
That's awesome.
I think some of the things I do on social media makes me seem like I'm a big extrovert, but really I'm very introverted.
And, it's interesting that you say that. I'm the same way. People think that I'm an extrovert. I am not at all. If I go to a networking event by myself without a friend or another colleague, I'm the person standing by the cheese table, just eating all of the, hors d'oeuvres and getting to know the person who's coming to refill them after I eat them all.
Yeah.
Somebody has to like introduce me to people if I'm in a room where I don't know anybody. If I'm in a room where I know everybody or I'm throwing the event, I'm the extrovert. But if I don't know anybody, it's hard for me to just go up and start a conversation. And I think
I
a lot of
totally
people
relate to that. Yeah.
Yeah. And, I have a girlfriend who's a huge influencer. She gets, she's a huge influencer on social media. I mean, she gets free Chanel. She gets invited to their shows. She's the quietest, most shy person that I'm friends with. But on social media, she's huge extrovert. So it's interesting how, people's perception is not necessarily reality. What is a story that you love to tell people, that you regularly tell people that you meet?
For me, that how this all started, which was it's a funny thing. I hate writing. Like I don't mind talking in front of a billion people, but I was never a writer. And how I started writing about housing economics, there was a CEO of a financial website called Benzinga, and the CEO's name was Jason Resnick. And he saw me debating politics with Michelle Cabrera, who was a CNBC anchor years ago. And we were just talking back and forth. And he just came to me and sent a message. Hey, listen, do you want to be our political writer? And I was like, oh, hell no. No. I don't do that, But you know what? I'll write about real estate economics. That's something I could talk about. If that didn't happen, none of this would be here, because I have no intentions of actually, creating my own blog. I created my blog after writing for Benzinga for about a year, but that's how this whole thing started. Right now, where now I'm an analyst and I talk about it, but there was never any intention of me doing this whatsoever at all, let alone get to this development stage over the last 11 years.
I love it. What was your last Google search?
The 10-year yield.
Okay, that's good. You know your stuff. I don't know what my last one was, but it was probably not work related.
Yeah, my Google search are all work related. Yeah.
What's better, a cannonball or dipping your toe in?
Cannonball.
Cannonball, you dive right in.
Dive right in.
Love it. I had one question from a viewer. Bruce Martin asked, is it a good time for him as a single man with no kids to move back and buy in New York City?
I've had this same answer to this question in general, probably for my lifetime. If you're asking someone else to buy, if you should buy a home, you shouldn't buy a home. And the reason I say this is that, when you're growing up as a teenager or you're maybe in college, your life choices aren't so many directed on you. You have financial support from other people. When you're an adult, it's all you. So you're buying a shelter cost, right? You're buying a payment. You're not buying a price or anything like that. And only you know the answer for that. So whenever people tell me, should I buy? I always tell them, no, you should. If the day you stop asking me if you should buy, you're ready. Because millions of people buy homes a year. Like last year, we had over 5.5 million people buy homes. Why? They're ready. We had tons of people buy during COVID. Why? They were ready. They were buying a payment. We had tons of people, even in 2008, we had over 4 million total home sales. So you yourself have to answer that question.
Yeah.
Do not ever let anybody else have that kind of power over your financial choice, because you have all your finances in front of you. And so when people ask me that, I was like, I have no idea who you are, and there's no way I can answer that. But the fact that you're asking me tells me you're not ready. Because home buyers, I've known this for over the when they're ready, they're ready. They're just buying a payment and they're good. You don't have to convince them. When people tell me, well, I'm not going to buy because you're not ready to buy. And there's nothing wrong with that. Absolutely. You know yourself. But if anybody asks me this question over the years, I always say, no, you're not ready, which also leads to some really interesting conversation because people go, wait a second. What do you mean I'm not ready? I said, you're asking me, you're not ready. You don't know me. Exactly. That's the point. So if you're asking me, you're not ready, right? You got to ask yourself in the mirror.
Yeah. All right. One final personal question. This is something that I personally enjoy so much is being an aunt. I don't have kids. I don't want them. I have 4 children. You really love being an uncle to your niece and nephew, right?
Yes. And I love kids in the sense that they're young and they're eager and they want to learn, they want to experience. That was the high school basketball coach of me.
Yeah.
I had 15 to 18 new kids every year, right? So you better like kids if you want to do that. And I took my great niece and great nephew to Disneyland for the first time, and enjoying that experience with them, and just enjoying that experience in general with kids. I loved coaching high school basketball so much. I mean, it was such a good, for me at such a young age, to try to develop young men into becoming more responsible men growing up, and trying to install values that you believe in. So I love that aspect about it. But yeah, people ask me, so your kids, where do they go to school? I homeschool my kids. I have a cat, a tortoise, and a goldfish, and so they get homeschooled every day.
That's awesome. Well, it's clear that you're the type of person that likes to make a positive impact, and you can do that in a coaching situation. And you're doing that in your work. It helps me on a daily basis what you do. So I thank you for that. You really shed a lot more light than anybody else that I know that talks about real estate. I really follow your advice and your data. You can't argue with data. That's, you just can't. And I love charts and spreadsheets and all that stuff too. So, that's it for today, but I really appreciate you coming on the show. I hope we can do it again sometime. Yeah.
And after all these years we've known each other, this is the first time we've actually talked. So
I know it's nice to see you face to face and get to know you a little bit better. And we'll plug your website and your social media handles and stuff in the show notes.
Thank you so much for having me. It was a lot of fun.
Thank you, Logan. I hope you enjoy the rest of your day.
You too.
Thank you for watching and listening to Kelly Minds Her Manners. Make sure to subscribe to the show, and don't forget to leave us a review to tell us what you liked about the episode. You can connect with Kelly at Kelly Minds Her Manners on Instagram and TikTok, or on our website, www.kellymindshermanners.com.